Thanks for joining us for the Executive Series. Today I'm talking to the CEO of the Australian Bond Co, Richard Murphy. Welcome, Richard.
Thanks, Tom.
Now, why don't we talk about your company, how long you've been around, and what exactly is it that you do?
Yeah, so Australian Corporate Bond Company has been around for 2 years, and what we are is the manager of a series of securities traded on the ASX. So we're not really a fund manager because each of the securities is an individual underlying corporate bond. So we have 16 of those traded on the ASX. Each one has a BHP, a Telstra, a Woolworths, 16 different bonds by 14 different companies, a couple of double up there. And we are the manager of those securities. There's a trustee of the trust, etc., and a custodian, but we're the ones who do the, if you like, the commercial side of the business.
Okay, so say for example, a customer wants to buy one of these bonds. How do they go about it?
So it's very much like buying anything on the ASX. So you'd have a broker or a financial advisor who essentially executes through the ASX broker, and you go in and you just put an order in as if you're buying shares or ETFs or some form of a listed investment company. So it's very much like buying and holding shares. 3 days later, it's in your CHESS account.
Okay, so you mentioned that portfolio approach to the bonds. Why do you do that? What are the benefits for customers in having that?
Well, I think the very obvious benefit is just straight up diversification.
Yep.
So you can buy many diversified types of funds over bonds. Not too many, but some of them we'd argue are maybe too diversified, and they've got lots of government bonds and semi-government bonds. So if you look at our 16 securities, you'd say, well, I'm not going to put all of my eggs into just the BHP basket or just the Telstra basket. I'll select 5 of those or 10 of those, and that will give me diversification. So it's diversification, so your credit risk is not just will BHP pay back its loan, will Telstra pay back its loan, etc. You're giving yourself a bit of a diversification, and then you can kind of get a blended return from all 5 or 10 or whatever you buy.
Okay, so another good question to ask is why would it be attractive for customers to be looking at this sort of investment?
Well, at the highest level, I think the GFC taught people unfortunately, a bitter lesson in terms of, are we truly diversified in our portfolios? Do we have diversification across asset class? My experience from 20 years at the ASX was, well, there's a lot of people who might consider banks and Telstra as a safe haven and then more riskier shares. So they're really diversified across equity, not across asset class. So that's point number one, is you really ought to be thinking about, well, where is my safer, my more secure capital? And a lot of people have that money in banks, in bank term deposits. But of course, they're coming down, and they're now around 2% and 2+% in terms of return. So a lot of advisors, a lot of brokers and investors are looking for, well, what else do I have in that fixed income? So really, it's the diversification you really ought to have, is saying, well, equities are great, and I have equities in my portfolio, but here's some safer, more secure fixed income that's negatively correlated. Shares go up, bonds generally stay stable. When shares fall, bonds usually rise. So you've got a negative correlation protecting your portfolio.
Richard, great insights into what you do. Thanks for your time today.
Thanks, Tom.
And thanks for joining us for the Executive Series.